All right. Well, good evening, everybody, and welcome to the Wealth Mindset and Real Estate Investing Virtual Meetup. My name is Chris Price. I'm the host of the Wealth Mindset and Real Estate Investing Meetup. I'm also managing partner at Boost Capital Group, and I'm also the CEO and co-founder of Red Fox Multifamily. And just before we get into tonight's presentation, which is going to be on the 2025 U.S. multifamily real estate outlook, I want to let you know a little bit about us. So, the Wealth Mindset and Real Estate Investing Meetup is open to all who are interested in growing generational wealth through real estate investing and increasing their financial intelligence. This meetup is for the busy professionals and retirees across various industries. The individuals in this group make a good living and have discretionary income to invest in real estate for its proven wealth building power, but don't have the time, skill set, or network to do it at speed and scale. This meetup focuses on helping us all grow our wealth mindset by learning how to build and preserve wealth while developing and maintaining an abundance mindset. This meetup will focus on multifamily real estate investing as well as other proven ways to build wealth through real estate through passive investments. And we're sponsored by Red Fox Multifamily. Red Fox Multifamily helps pharmaceutical and life sciences industry professionals diversify their portfolios and add passive income and get all the benefits and perks of real estate investing without having to do any of the work themselves. Red Fox Multifamily partners with passive investors to buy commercial multifamily real estate based on vetted opportunities we get access to from our trusted network of operators in the best markets throughout the country. Partnering with Red Fox Multifamily makes investing in real estate completely hands off, allowing investors to add passive income, build equity, and save on taxes, all while being an investment vehicle that is backed by a hard asset. All right. And our other sponsor for tonight is Boost Capital Group. Boost Capital Group's vision is to become premier partner for busy professionals and entrepreneurs seeking to build and preserve their wealth through passive real estate investments. So just before I get into the presentation tonight, a couple of logistics for you, for some of you who are first time folks who are on the line. For those of you who have been here before, thank you first and foremost again. And just so we go through this, please mute your lines when you're not speaking. If you could hold your questions to the end of the presentation, we'll be happy to handle all of the questions that come up. Please note, for those of you who just joined, this presentation is being recorded. And also note, this material does not constitute an offer or solicitation to purchase securities. This is information only and should not be construed as business, financial, or legal advice. And so the last thing I'll mention is I always like to get connected with people. So for those of you who are checking this out live, or for anyone who is catching this on the recording when it is posted on YouTube, please reach out. I love talking real estate, talking business, and what's going on in the world, and how we can all build wealth passively with real estate investing. Reach out to me. Happy to stay connected and share resources, insights that I have with you as you're continuing on your journey. So thank you very much in advance for connecting. So without further, let me move on to the U.S. real estate market outlook for 2025. And again, my focus is specifically on multifamily. The commercial real estate market in general is a very diverse field, everything from office to industrial to retail to to multifamily, you name it, it is very diverse out there. However, my focus for this evening is specifically on the multifamily market space, where we do primarily focus on. While we do explore other asset classes and are in other asset classes at Boost Capital Group, the focus of this presentation is going to be on multifamily. So The U.S. multifamily real estate market is poised for continued growth and evolution in the coming years. The presentation will explore a few key things from trends to forecasts and insights that will shape multifamily sector in 2025. So I plan to dive into factors driving demand, changes in consumer preferences, and emerging innovations that will impact multifamily development and operations. So for all of you out there, by understanding these market dynamics, we can better position ourselves to capitalize on the opportunities that lie ahead. So let's talk a little bit about the cyclical recovery that's just ahead. So multifamily has remained the dominant investment vehicle in commercial real estate, commanding about 38% of allocations from institutional and private investors expected in 2025. Um, Demographic shifts and housing affordability constraints are driving sustained renter demand, leading to strengthening occupancy and accelerating rental price appreciation in the multifamily market. So translation, as people continue to and population growth continues to flood high growth markets, we are going to continue to see an increased demand for rental property, and we're going to also see the occupancy of those buildings increase as well in those areas. There's some dynamics that we'll talk a little bit about when we go through this presentation that I'll point out, but it's important to note that all of those factors also are key drivers into why rental price appreciation in the multifamily market in some key markets will see an increase as a result of all of those factors and others. So market analysis projects multifamily vacancy rates to compress to 4.9% while achieving consistent rent growth of 2.6% annually through 2025, which is outperforming historical averages. So the past few years have seen a record surge in new multifamily construction, particularly in the Sun Belt. So for those of you who may not know, the Sun Belt consists of places everywhere from the Carolinas, Tennessee, Georgia, Florida, Alabama, etc., all the way through Texas and Arizona and Nevada, essentially. These markets and the Mountain West are seeing a surge of new multifamily construction. And it has continued to be that way. And many of the high supply markets have already reached their peak for new deliveries, meaning that the supply pressure should start to ease. We're starting to see, however, occupancy rates improve in markets that previously have negative rent growth and are expected to turn positive, and again by 2025 as the recovery accelerates. So this combination of peaking supply and accelerating demand recovery sets the stage for a healthier multifamily market going forward. So let's talk a little bit about some market specific supply dynamics. So over the past several years, we've seen the peak of new deliveries in 10 out of the 16 largest real estate markets. Looking ahead, six key markets: Charlotte, North Carolina; Fort Lauderdale, Florida; Phoenix, Arizona; Raleigh, North Carolina; Riverside, California; and San Antonio are expected to reach their peak in 2025. However, the future outlook for all of these markets is positive, with improved vacancy rates and rent growth anticipated in the coming years. So, as new supply tapers off, these markets should benefit from more favorable supply dynamics and strong performance. So rent growth versus mortgage payment forecast. So, one of the key trends that continues from previous years into this year is this cost differential between the cost of renting versus owning. And this, it continues to grow, and it continues to be a key driver for the demand of multifamily housing. And I'll share a few key points with you here so that you can really get an understanding of why multifamily is such an interesting asset class when it comes to the demand for housing. So construction starts for multifamily housing are expected to decline significantly by mid 2025, reaching a 74% decrease compared to the peak in 2021. Multifamily construction starts are projected to remain 30% below pandemic levels, which is really substantial. Strong renter demand is expected to drive above average rent growth by 2026. So what we are noticing here is that as we have a situation where we have these strong markets where the population continues to increase, the demand continues to increase for for housing in general, for those folks who are interested in buying their next home or renting their next home. There's a lot of competition out there. Also playing into this, that I'm not going to go into a lot of detail on, but the Federal Reserve and what they are doing in terms of advising on interest rates and how that is impacting folks that are looking to either purchase homes or develop new multifamily properties. All of the cost of capital to do these things has increased substantially in an effort to reduce or slow inflation. But those things are also having an impact on people's ability to purchase homes. It's having an impact on whether or not people can can or developers can build new homes or build new apartment complexes. So these are very intertwined, and it'll be interesting to see how things continue to play out throughout the course of the year. But drilling down into this a little bit more, there are some significant home ownership challenges. And the key challenges facing home ownership today are mortgage rate lock-ins, cost disparity, and regional variations. So let's talk a little bit about mortgage rate lock-in. So if you think about it, during the pandemic, when the government and our interest rates were lowered by the Federal Reserve, I should say, we saw record low interest rates for that were available, and many homeowners at the time took advantage of this by refinancing already relatively low mortgage rates into even lower mortgage rates, taking advantage of the 2 and 3% interest rate mortgage rates compared to the 4 or 6% range that they were paying just before this. And by doing that, they've locked these rates in, and they're really not interested in moving. And part of the reason for that is because now, if they were to buy that same home that they live in today, and have to get a new loan on it, that loan would cost them double or triple what they had previously locked in during the pandemic. In addition to that, they would also be challenged with the fact that depending on where they are in the world, or in America in particular, especially in the markets that we're talking about, we're seeing substantial increases in an appreciation of homes. The home prices have appreciated because there's not a lot of new construction coming online, and there's a ton of demand for that housing, for those single family homes. You all have heard the story where people are competing for that one house, or even for the house that's the ugly duckling on the street. People are really sacrificing some of the things that were must-haves before, just to get into these things, if they are so willing to pay the price to do so. So this is a really important thing that's going on here when we talk about locking in those rates. Then, so 80%, for example, of homeowners have mortgage rates below 5%, which ultimately discourages them from selling their homes, and moving out. It's not an incentive to sell your home when you have a below 5% interest rate. And in major markets, the monthly cost of buying a house is forecast to be 2 to 3 times more than the average rent. So think about that for a minute. The cost of home ownership and the American dream is very expensive for folks, and many people cannot afford those things. And when we think about it, especially in some of the regions, this is important because people need a roof over their head. They need that shelter, and focusing on the thing that resource that is required for them, or an essential for them, I should say, is something that is going to become and continue to be a priority. So the Midwest, Northeast, and Gateway markets show stronger rent growth potential in 2025, which could impact the cost disparity. So these factors make it increasingly difficult for prospective home buyers to enter the market, especially for first-time home buyers. And it's a tough time out there for new home buyers trying to get in and into a market with such high competition for little supply, and you have a host of other things that are coming out there. So in terms of the 2025 market outlook, it's looking quite promising with several key trends that we should highlight. So first, we're seeing construction pipelines shrinking across many markets. This means that supply will be more constrained, which should drive stronger demand from renters. And speaking of demand, we're projecting renter demand to be and to remain, I should say, robust in the coming years. And this will help drive occupancy rates even higher. And occupancy rates improve, and as they improve, I should say, we anticipate rent growth will accelerate across all markets. This should translate to stronger financial performance as well. So overall, the combination of shrinking supply, strong demand, and rising occupancies and accelerating rent growth paints a very positive picture for the 2025 multifamily market outlook. So let's talk a little bit about cost to buy premium favors rentals. So this cost to buy premium, or the difference between mortgage payments and average apartment rents, currently stands at 35% higher for new mortgages. This was something that actually Redfin had reported on last year, and this is a consistent trend that we're seeing, that the cost of a home mortgage compared to renting is just substantially higher, and many people cannot or do choose not to afford that, if they even if they could. And so over the next 5 years, we expect to an average multifamily rents to grow by 3.1% annually. And as a result, the cost to buy is projected to ease from 35% down to 32% by 2025. So this is still, it's a reduction, but it's still substantial when you think about the cost of buying premium. And this trend favors rentals as the premium for buying a home continues to remain high compared to the average cost of renting. So let's get into a couple market specific cost premiums, just as an example. Austin and Los Angeles are leading markets with home buying costs exceeding 2.5 times the average rent. Emerging markets like Phoenix and Salt Lake City, Nashville are seeing the most significant compression in the cost to buy premium. And strong renter demand combined with decreasing construction activity is driving accelerated rent growth across key markets. So when we talk about mortgage payments and are currently 35% higher than rental costs on average across the US. However, in some key markets like Austin and Los Angeles, as I mentioned before, we have those costs of home buying is up to 2.5 times higher than renting. And as I mentioned before, and just to drill this point home, the uh, uh, cost premium for home ownership is expected to moderate to 32% down from 35% as market conditions shift. However, the factors driving these higher housing costs include a 5% rate lock or 5% or below mortgage rate lock in effect, plus 3.1% annual rent growth and market specific premiums in places like Phoenix and Nashville. These are things that really are factoring into the cost and the overall expense of home ownership versus renting an apartment or a home. So some other thing just to quickly mention, I mentioned, multifamily is our key area of focus here, but I found it, timely and relevant in light of recent announcements from government officials about significant investments in data centers, in the United States, upwards of $500 billion. We hear a lot of tech leaders with the new Stargate proposal. We hear a lot of tech leaders also speaking about their desire to continue to invest significantly in AI and data centers and all of the things that will feed this monster, this beast, if you will, to continue to help things grow. And so I wanted to provide a brief insight that I gleaned from this report on data centers. So data centers are a key focus area for the presentation because in particular, the industrial and logistics sector is another important topic. And so the two areas that I wanted to particularly call out are data centers and industrial slash logistical type of facilities. And they're closely connected, however, to the overall, technology and infrastructure themes that we have seen going on and are in the news and are consistently talked about. So it's important to also be aware of other areas and other trends that might be as opportunities for us to consider when we think about this. So, where the investment dollars are going from business and from government, and substantial investment dollars. If you think about from a real estate perspective, when we are when there's significant investment in these areas, wherever they're going to be, some of these data centers may be in Texas or some other places in the Midwest. People have to live there. Where do people go? People go to where the jobs are. And if the jobs are flowing to these places, so goes the rental housing and apartments and all the other housing needs from a real estate perspective that surround it are also related to where the investments go. So I want you to make sure that you're considerate of those things as well when we are looking at these types of opportunities for us to invest. So, so let's talk a little bit about multifamily availability and the tightening of that. So, multifamily vacancy rates have dropped to 5.3% in Q3 of 2024, indicating a tightening market. But strong rental demand is outpacing new supply, which is further tightening the market. So, no matter how much supply comes online, that supply continues to be absorbed by the demand for housing for people moving into these markets that we're focusing on. So this tightening ultimately signals positive momentum for the multifamily sector. And there are various different strategies within multifamily, but what I wanted to make sure that is to call out, a couple of them, that we particularly focus on, and core and value add multifamily improvements. So when we think about it, we want to talk a little bit about, core and value add have shown improvement all the way through Q3 of 2024. And this is a positive trend because it indicates positive, flow for multifamily. And don't get me wrong, there is a lot still going on in the multifamily market. There's still some distress out there for some of those investors that invested in multifamily housing, or multifamily apartments during the pandemic. And during the pandemic, they may have secured a variable or floating interest rate loan, but they did not get a rate cap or didn't plan for a rate cap to for the rate cap to increase at the rate and that it did. And many investors and operators are in some distress out there. So don't get me wrong that there are not issues or some trouble that is happening within the multifamily market, but overall there's a lot of positive signals in this space that as savvy investors we want to make sure that we're poised and positioned to be able to capitalize on them and be able to weed out those investments that we are not that may not check our buy box, so to speak, and focus in on those that maybe do check our buy box. So let's make sure that we're focusing on those things as we continue to grow. So let the last slide that I want to make sure that I summarize the 2025 multifamily outlook here is that housing supply shortage. As I mentioned earlier, this persistent housing supply shortage is projected for the next 5 to 10 years, especially in these key markets that we are referring to. And when we experiencing this, or this is going to create an interesting dynamic within the marketplace for that demand for housing and the need for folks to be able to have that roof over their head, as I mentioned before. We're going to, from a population growth perspective, there are very favorable demographic trends driving market expansion. We also, see this as a wealth transfer. So, this is a significant wealth transfer opportunity as we see, baby boomers and this idea of the silver tsunami, and some of those asset owners of multifamily properties selling them to the newer generation, if you will, who are acquiring them and improving them and being able to build and grow their wealth is all a part of the opportunity that exists here as well. We're also, from a market stabilization standpoint, the recovering transaction activity and stabilizing valuation. So, we saw during throughout the pandemic and just briefly after the pandemic, we saw quite a bit of run up when it came to the acquisitions of multifamily properties, where pricing was very high, transaction volume was very high, and then we saw a significant cooling as the Fed continued to increase interest rates to slow inflation and to slow things down. And with that also came a substantial reduction in transaction volume as it relates to multifamily properties. And like I said, some of those were distressed, some of those were not. Excuse me. And then what we'll also see is in 2025, as as we continue to monitor what the Federal Reserve does, what treasuries do, we will see the market continue to react to those things, and dependent upon those factors and others, that we've talked about throughout the course of this presentation, we may see some additional stabilization take place. It's also important to note that there are some political risk. To name just a couple here, when it comes to political risk, we are really interested in making sure that we are paying attention to a couple of key things. So the current administration has spoken about tariffs as an example. If tariffs, in some reports, if tariffs were to be applied to nations in which where we import materials to build homes or construct new apartments or whatever the case may be, this may have an obvious negative impact to the cost of developing new multifamily housing or renovating multifamily housing as a result of the cost of the materials alone that may be coming from nations that are on the list of nations that would be applied tariffs as an example. And then the other reports, specifically one of the reports that I read from the Wall Street Journal, did a report and analysis on the potential impacts of immigration policies and how those may also impact the multifamily or real estate sector, but in multifamily in particular, when we think about our nation and the immigration policies that exist, many construction sites have laborers who may or may not be here legally, who are working and helping to construct, important, buildings and things of that nature, and the cost in those particular situations, of that labor versus other labor may be substantially cheaper. And if this were to change, the cost of that labor may increase. And so these are some things for folks to be mindful of. And then lastly here, as we summarize some of the key topics from tonight, affordability pressures. And what I mean by that is income pressures and potential economic slowdown in 2025 is something that is potential. When you have increasing cost of home ownership, increasing cost of renting a home or an apartment, these the affordability challenges that are upon some families is a real challenge. And so how do we address those things? How do those things materialize throughout the course of 2025? There is a potential for economic slowdown, depending on other economic factors. We are still at the end of January already, but still at the very beginning of the year of 2025. What does the future hold for us? And I think there's a lot still to learn there. So these are really just a couple of key points that I wanted to make sure that I could summarize for you guys. And what I wanted to also let you know is that to put together this presentation, of course I used a lot of resources to be able to share these insights with you and distill them down into just a few slides, so that to give you a 30,000-foot view, if you will, on what the multifamily market from a real estate perspective is looking like. And so everything from government resources to other research institutions and well-known real estate firms and financial data sources were all used to help me put together this presentation for you all this evening. and I hope that you gained some knowledge and insights from it. As I mentioned at the beginning of the presentation, I want to connect with you. So, if for those of you who have not connected with, or if I've connected with you before, would love to connect, see what you're interested in this year, see how we can build and grow together in 2025. So please scan the QR code and feel free to reach out to me, set up an appointment for a call. So with that, I will end the presentation and thank you and wish everyone a good night. And we'll wrap it up and we'll do Q&A right now. So thank you. So thank you guys for staying back. I hope you got a lot out of that. Let me stop the recording here.